Hi guys, welcome to the part 7 of the swing trading strategies video series. So in this particular part, I'll be talking about outside bar candlestick pattern. Now this is a major reversal pattern which plays out mostly during end of a major downtrend or uptrend, particularly relevant in the kind of times we are into right now. And it's actually a good strategy to have in your arsenal in case you're looking to go long or go short on certain stocks that you have in mind. So in this particular part, I'll be again starting out with instrument selection. The only thing that you require in this strategy is just the price chart, that is candlestick chart. I'll explain you what outside bar candlestick pattern is. This is actually a bar chart pattern, but I think on a candlestick chart that this kind of looks much better, and you can actually visualize what is happening in the market well. I'll be showing you various types of outside bar candlestick pattern as well, because this pattern particularly plays out in many forms or many variants. I'll be covering those. Then I'll be emphasizing on time frame selection, entry, exit, stop loss, and I'll take up various case studies, that is both past and the recent ones which have played out. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So the first thing that I'll start off with is instrument selection. Now this strategy is suitable for both stocks and futures in case you're not looking to short sell in the market, as many traders are not comfortable short selling. You can simply stick to stocks. The idea behind this strategy is to get about 20 to 30% return. Remember in the part 6 strategy, the kicker pattern that we saw, that usually yields about 5 to 15%. So return wise, this strategy offers better risk to reward. Under this strategy, we are not holding positions for few days. We'll be at least holding the positions for few weeks. Let's say anywhere between 2 to 4 weeks. And what we are looking to do is we are looking to either buy or short into a sudden reversal in an ongoing strong trend. I'll be precisely showing you how to do this. Again, this strategy is purely to be traded on price action, that is simple price chart, but in case you want to include any indicator, you can do so. And you just require either a web-based platform or a technical analysis software. My preference is always to have a proper software. The time frame that we'll be trading this strategy on is only weekly time frame. Now I know this strategy works on daily as well, or on hourly chart, or a 30-minute chart as well. But what I have found is that on weekly chart, this strategy actually works the best. Now I'll directly take you to this pattern first. Before that, I'll just show you what a basic candlestick chart looks like. This is a bearish candle. Here, open and high are the same level. Price auctions lower. At some point during the day, it makes a low here and then closes at this level. On the flip side, look at this bullish candle. Price opens here, rallies on the upside. At some point during the day, it makes a high here and it eventually closes at this level, with low being at this point. So this is how a basic candlestick looks like. I'll take you through the outside bar pattern. Now this is how the pattern looks like. In this particular pattern, you have to think psychologically. Just imagine we have a bunch of green candles here and price has moved up to this point. All the people who have bought are feeling pretty good about it. And the next day, look what happens. Price opens here above the high of the previous candle and it auctions lower and completely engulfs this previous candle. So the high point of this candle, open point, low point, and the close point is completely engulfed by this second candle. Now this signifies a significant shift in the overall psychology of the entire chart. Now on the flip side, if you look at this particular pattern, which is a bullish pattern, here what you see, price trends lower. Then we get this first candle, which actually signifies the ongoing trend. Next day, what happens is that price opens at this level, it auctions lower, that is moves lower below the low point of the previous candle, and then suddenly you see a spurt of buying emerging, and then candle closes above the high point of this day. Now this is what I was referring to earlier, that the second candle of this pattern is actually the most important candle, wherein it completely engulfs the previous candle, signifying a change of trend. Now I'll take you back to the definition slide, just because you've seen the pattern. So outside bar pattern is actually a two candlestick reversal pattern. The first candle usually confirms the trend, that is this candle and this candle, and the second candle actually confirms the reversal. Now, this is one main condition I have put out here, that the close of second candle should be higher than the high of previous candle in case you are looking to buy. What I mean is the close of this second candle should be higher than the high of this previous candle, right? And on the flip side, the close of this candle should be lower than the low point of the previous candle. That is how you signify a complete shift in psychology of the chart. I hope my point is clear. So the two main requisites that I have categorized for this particular pattern, the number one is the trend has to be in place, a prior trend, that is whether uptrend or downtrend, and minimum 6 to 10%. In my opinion, the larger the better. And reversal candle has to be extremely decisive. That is, the signal from this candle should be that a complete psychological shift has happened and now price is willing to trend in the opposite direction. That has to be conveyed in a very decisive manner. So again, we'll be trading this pattern only on a weekly time frame chart. Make sure that before you trade this pattern, there is a sustained trending move before it. And if there is a visible trending move, larger the better, that actually increases the odd of this pattern playing out. This particular pattern, if you have some basic knowledge in candlestick charts, this particular pattern is actually a strong variant of bullish engulfing. So in bullish engulfing, the criteria is not so strict or rigid, but for this outside bar pattern, this is actually a stronger variation of bullish engulfing pattern, which actually works quite well. I'll now take you through the different kind of outside bar patterns that you'll spot, both the bearish part and the bullish ones. I'll start with the bearish outside bar first. So have a look at this first pattern. Now what has happened? The previous candle is positive. We have an opening here. This completely engulfs the previous candle, and we clearly get a closing below the low of this candle, right? Now look at this candle. Now what has happened is that this candle is again signifying the prior trend. Price opens here. At some point during the day, it makes a high, and then it completely closes below the low of this candle, right? Now look at this candle. This has been a fairly bullish candle signifying the previous trend. And the next day we get an open here. Price auctions high, makes a high here. Then it makes a low and closes nearly at the bottom point of the day. Again, completely engulfing this candle. Now look at this variant. Price fairly represents the bullish momentum in the previous trend. Then the price opens here, forms a high at this point, forms a low at this point, then closes here, completely engulfing the first candle. Again, you see with this particular pattern, price opens here, makes a high at this point, makes a low here, and closes at this point, thereby completely engulfing this first candle. Now look at this candle. Price makes again a bullish candle. Price opens here, makes a higher high here, higher than the previous candle, completely closes at the lowest point of the day, thereby engulfing this first candle. Now all these patterns that I've showed are actually variants of outside bar candle pattern. Now the key in this strategy, that is to trade on the downside, is to identify which pattern is most bearish and why. Now just for a second, pause this video and try and figure out which of these patterns is actually the most bearish and why. So if I have to pick out, I would say that this particular pattern is extremely bearish. Why? Because this pattern actually, this first candle signifies strong buying momentum. A lot of buying has happened. That is why price has moved up, forming a long tail. And then look at this reversal candle. It is closing at the lowest point of the day after completely engulfing this previous candle. Similarly, if I want to point out, this pattern would again be a very strong variant. Why? Because we have a really bullish candle that is representing the previous trend. Then suddenly we get an extremely strong reversal that is closing towards the low point of the day. Whereas if you look at this candle, or this candle, they are actually signifying the same bearish outlook, but the intensity with which this particular pattern or this particular pattern or even this one, they are signifying the shift in trend, that is not being conveyed by either this one or this. So this is also a kind of practice thing that will come over a period of time, that you would be able to finally make out which patterns are more bearish and which ones are more bullish. I'll just take you to the bullish variants one. Now look at this, again the same pattern playing out in the opposite direction. So this is a bearish candle signifying the previous trend. Then again you get a reversal here, this candle completely engulfing the first one. Similar is this one. Psychologically, this is a very bearish candle with selling representing at higher level. The price for this candle begins at the lowest point, that is below this particular candle's low, and completely engulfs the previous candle. And you can see the remaining three patterns as well. So again, pause the video here and identify which candles would you see, or which patterns in these particular 6 patterns that I've listed out are the strongest one. If I have to pick out, then I would pick out this. This one is extremely strong. Again, this candle represents the previous bearish trend uh, pretty strongly. And then look at this reversal candle. Again, price opening here, making a low at this point, then completely engulfing and having a strong bullish candle. Similarly, this candle is completely, it's much more stronger than something like this or even something like this. So out of these 6 variants that I've shown you, the ones which I like as the most strongest are this pattern, and this pattern. If you look at this particular pattern, this is actually just closing at the highest point of the previous candle. So, this has just about qualified, but still it's a strong pattern. But look at this, a decisive closing above the high point of the previous candle. Similarly with this one. Even this one is not that weak, but look at the length of these candles. This actually signifies that there is a lot of underlying bullish momentum. So I'll just begin with the case studies first. What I've purposely done is that I've picked out some case studies that have happened in 2012, 13, 14, and 15. And then the recent move that we have seen where stocks and indexes have fallen down, I'll be showing you how this simple strategy has picked out reversals in many stocks and many index that we track on a daily basis. So I'll just move to case studies now. So the first case study that we'll pick out is that of Bank Nifty. Now this is of 2016, again a weekly chart. Now here what we see that we have had a decisive downtrending move that has played out in 2015, and before March 1st, that is, I think this was on the budget session, what happened was the previous candle was a bearish one, and then price opened at this level, made a low somewhere lower than the previous candle, and then we had a strong bullish candle playing out and price closing at the high point of the day. Now, the criteria that I had said, number one, the prior trend in place, it was clearly there. First candle was reflecting the ongoing trend. The second candle was very bullish and it completely engulfs the first candle. Look at one thing in this particular case. Now, what has happened here is that this particular candle has actually engulfed this one, this candle, then this one, and this one. So the last 3 candles have been engulfed by this particular bullish candle. So these sort of things also give you an insight into how strong this reversal pattern has played out in this particular case. In this Bank Nifty case, then you've seen that price has clearly trended higher, that is on weekly time frame, and this particular candle was clearly reflecting the shift in momentum from sellers to buyers. So this was the first case that I covered that happened with Bank Nifty instrument in 2016 March. The next case study that I'll pick out is that of FMCG index. Now this is of December 2016. So again, what we have is a previous downtrend in place. It was 15% downtrend that happened. After that, the first candle reflected the mood of this particular index that was trending lower. Look what happens in the second candle. We open at this point, make a lower low with respect to previous candle, then auction higher, that is close higher at the and near the highest point of the day. Now again, this particular candle actually engulfs three candles, that is this one, this particular one, and this one. If you see, it also engulfs this candle and this candle. So this particular bullish candle has actually engulfed 5 previous candles, again decisively showing that the shift in momentum is here to stay, and now the trend has shifted from downtrend to uptrend. See, it's easy to see that uptrend has happened here because we have the data printed on the right side. But when you are here, you're actually playing with probability and not certainty. Now, just imagine this particular chart is not present. So, what this candle actually signifies is, number one, that downtrend may have ended, and number two, any trade that you want to take in this index or this particular stock in FMCG index, that has to be with respect to the lowest point that is made in this candle. I'll come to the entry, exit, stop loss part a bit later, but that is how you have to think. And just remember one thing, that when you find a bullish candle that is completely engulfing 2, 3, or let's say 4, 5 previous candles, then that is an extremely bullish sign, and you should be paying attention to that particular chart. The more decisive this second candle, the higher the probability of the pattern playing out in your favor. So which is why pay attention to this particular candle. What is it doing? How it is closing? Whether it is closing at the highest point of this particular candle? What about the low point? Whether it is a decisive low point? How many previous candles is this pattern actually engulfing? All these sort of details you have to pay attention to. So the next case study that I'll pull out, that is of Nifty Next 50, that is Nifty Junior. So this is of 2012. Now we had a prior downtrend in place, again 10-15%. The first candle that you see represents the existing downtrend. Then look at this second candle, what happens? It makes a clear low with respect to this candle. Then the price opens here, it makes a high here, and this closes above the high of this previous candle. Now this particular pattern is not as bullish as what we saw in Bank Nifty, or for that matter FMCG as well, but it overall signifies the shift in momentum that has happened from sellers to buyers, and which is why this pattern should have been traded on this chart also. But when you want to compare it with Bank Nifty or FMCG chart, then clearly Nifty Junior chart, the pattern that has played out in 2012 is weak when you compare it with something what played out in 2016 in Bank Nifty or 2016 December in FMCG. The next example that I'll pick out is again of FMCG, but it's just of last few weeks, that is in September. Now look what had happened. We've seen a lot of sectors and stocks breaking down. In this particular case, it's the FMCG index. The breakdown happened in first week of September. Now again, a clear trending phase was visible, 15% trend was visible, 10 to 15%. The first candle is again reflecting the mood existing on the chart, that is price is trending higher. Now look at the second candle, how bearish it is. The opening is exactly at the high point of the candle, and then price auctions lower and finally closes somewhere here. Now again, in this particular chart, you see that this particular bearish candle actually engulfs 1, 2, and almost this candle, that is 3 candles. So when you want to measure the bearishness of this pattern, then FMCG being a defensive sector and such a wide range candle printing on it definitely sends out a negative message. And since then you've seen price has clearly auctioned lower. So 2 things you have to check: 1, prior trend in place, and number 2, how strong the second reversal candle is. In this particular case, this candle is exceptionally strong, which thereby qualifies as a short trade. Now the next example that I'll pick out is of media sector. Now we see a prior trend in this chart, right? Now selling is also evident as this candle has engulfed this previous candle. In hindsight, you see that this pattern has also worked extremely well, but still uh, I'll categorize this particular pattern as a weak pattern. Now just pause the video and think for some time that why I categorize this as a weak pattern. The criteria have fulfilled, selling was evident, it has worked as well, but why is this weak? Now based on whatever we have discussed in the previous slides, you should be able to answer this question now, that why this particular pattern is weak than something like this, a short sell example that we have seen before. So just pause it here and think why this is weak. Now the reason I categorize this pattern as weak, I'll just zoom this for you. This pattern that is formed here, I've just zoomed in. Now look how the closing is happening. The current candle close is actually not below the close of the previous candle, that is the low point. Again, I'll repeat, the closing point of this candle is not below the low point of this candle. So while criterias are being fulfilled, one major criteria that is missing out is that the closing has to happen below the low point of the previous candle. So this pattern on the media sector does not necessarily work out as a outside bar candlestick pattern. This is a simple bullish engulfing that has happened. Rules wise, yes, all the rules that I've listed, you can still categorize it as an outside bar pattern because the high has surpassed the previous high of the candle and the low has surpassed the previous low of this candle. But in terms of strength or in terms of bearishness, this pattern is not as bearish or nearly as bearish as what we saw in FMCG sector, because here the close were clearly lower than the low of the previous candle, whereas in the media sector case, the close is just about lower than the open of the previous candle, not at the low point. So had the close happened somewhere here that is clearly lower than the low of this candle, then this would have been categorized as an extremely strong bearish reversal case. I hope my point is clear here. Do remember this, that the current candle closing has to be below the low of the previous candle, as it will signify more strength. This is a point to remember. Now I'll move to again Nifty next 50. So this is a case of 2017. Now why I've pulled out this case is that I wanted to show you that this pattern fails as well, no matter how strong this pattern looks. If you look at these two patterns, now this candle was signifying the past trend. Look how bearish this candle is, but despite of that, this pattern failed. Again, a similar pattern played out. This candle was signifying the past trend. Again, a very strong bearish pattern, but again, the stop loss was hit and the trade failed. So I want to highlight one thing: nothing works always, and it always has to be in context with what is going on in overall market. But look at what happened in Nifty next 50 few months down the line. In August and in October last year, while both these patterns failed, now look at what happened pretty recently in April and more importantly in September. Now a prior trend was there in place, but not that strong, but still it worked and price moved lower. But in this particular case, you do have a 10% move. Then you see opening of this candle at this point pretty close to the high point of the candle, and then a clear close below the low point of the previous candle. And since then we have seen price move lower. Now what would have made this candle more bearish, or with this pattern more bearish, if the closing point that you see here would have happened somewhere closer to the low point of the candle? That would have signified a more bearish momentum in this particular pattern, but that did not happen, and price did auction higher. But over the subsequent weeks, you've seen price coming down. So I hope you are clear on two things. One, the required conditions that are needed for this pattern to play out, and number two, to measure the strength of bearishness in this particular strategy. Now, if you look at this pattern and this pattern, out of these two, I think this is more bearish because the closing point is clearly lower than the low of the previous candle. And look at how bearish this candle is. If you look at this candle, it is still bearish. It sort of checks all the rules that we have covered, but look at the low point here and look at closing here. You do get a feeling that some sort of buying has happened and the price has not been able to close near the low point of the week. So this is what I want to cover on the strength of this pattern, how you assess whether this pattern is on strength parameters, whether it works out well or not. Now I want to come to a individual case study, that is of Kotak Bank. Again, this is a pretty recent example. So we have had a 10-15% prior trend in place. The first candle is actually signifying the trend pretty clearly. The next candle, look at the next candle, how it plays out. It opens at this point. A high is made that is higher than the previous candle. And clearly there is a close happening below the previous low of the first candle and near the low point of the current week. Now look how bearish this looks in comparison to something like this that we saw in the previous slide. And you've seen that since then price has fallen. So in terms of checking the overall strength of the pattern, this is how you have to go about. So the next example that we'll take up, again, it's a stock, a banking stock, Axis Bank. Now, again, we have a prior trend in place. We get a bearish candle here. It's pretty bearish. That is representing the previous trend pretty clearly. Then we get a fairly bullish candle. Look at the strength of this candle. But look what happens here. Instead of price rallying in one direction, first you get some sort of selling. Price again retraces back to the low point of these candles, and then it moves up. So it was not a directional movement, which actually brings to notice a very important point, that just because a bullish candle or a bullish pattern is formed, it does not mean that you'll get a runaway move right away. It is possible that sometimes it retraces back and then the pattern plays out. But the lowest point of the second candle, this actually becomes your reference point, and the price should not dip below the lowest point of your reversal candle. Now, if you see on this chart, this pattern actually also played out in November 2015. But look at the context of the pattern that played out. Had I seen this pattern back in November 15, I would have traded it because it's a pretty strong pattern. Although when you look at a candle here, which is actually, this candle is actually more bearish than this bullish candle. So these are some pointers that you have to take a look at. Although I must admit that these pointers are more visible in hindsight and in real time, because you're so eager to take a trade, sometimes you do make a mistake. But this is something you need to keep in mind. If you look at this bullish candle that is formed, this is actually more bullish than this previous two bearish candles, right? So these are just some minor points that you have to note or take a note of. And while analyzing a trade on your own, you need to keep these a few things in mind. So while pattern failed here, a couple of months down the line, this actually gave you a major reversal and then price moved up. One thing I want to point out straight away is that the beauty of this pattern is that you will see this pattern forming only at the end of major trending moves, which is why it is a rare pattern. It does not form that often, but you will find this pattern forming at a major after a major trending move, either uptrend or downtrend. Now I'll come up with one more case study with volumes in it. Now this is a stock. I think I have not mentioned the stock name here. I've forgotten that. So look what has happened. Again, we have a prior downtrend in place, 10-15%. And this first candle is clearly signifying the bearish momentum. Then you get this super bullish candle. It's clearly more bullish than what you've seen here. And then price consolidates a bit and then moves higher. Now, why I've pulled out this case study is because of the volume. Look at the volume here. as this bullish candle has formed, the volumes have actually spiked. Now, this is not a criteria that has to fulfill, it's not mandatory. But if you find such cases happening where price is trending lower and then you suddenly see this reversal pattern kicking in with good amount of volume, then do take note of it. Volume is very similar to adding fuel to fire. So if fire is represented by this particular candle, then volume becomes your fuel. So which is why I always like to pay attention to those particular stocks or charts which are breaking out or forming very good bullish reversal or bearish reversal patterns which are happening on huge volumes. You should definitely take note of those charts. Now, next case study is of a stock Havels. Just now I showed you how volume does play an important role. Why I pulled out this particular chart is because while the bullish pattern was playing out in this particular stock, you can see that the high of this candle is higher than the previous candle. The close is also fairly bearish, although I would have preferred a close somewhere near the low point of this current candle. That is clearly lower than the previous one. But you can see that as this bearish candle was forming, there was no distinctive pickup in the volume. So which is why I have not added volume as a filter, because sometimes it happens on great volume, sometimes it does not. So that is why I cannot put out volume as a filter. But definitely if you see something like the next chart that again I'm going to show up, that is of Godrej Consumer. It's a pretty defensive stock, but look at how it reversed in September 2018. Again, a trend of 10-15% was in play. We got a high that is higher than the previous candle, a clear close below the low of the previous candle. But look at the volume spike that has happened. The volume on this particular day was highest that we saw in the last 1 year or so. So when you see these volume expansion happening, when this pattern is playing out, that actually becomes an extremely bullish signal, and you should be taking or trading those trades because the odds of these trades working out is always good. So I'll just move to the entry, exit, and stop loss section. I've covered about 10 to 12 case studies. I'll just replicate this chart to explain you about entry, exit, and stop loss. So clearly at the end of the week, when this candle forms and the closing happens, this becomes your entry point. The high point of this candle, your entry candle, becomes your stop loss when you're short selling. In case you're buying, I'll just pull out a buying example. So this is a buy example. In case you're buying, this low point of the entry candle becomes your stop loss. So the second candle, that is the entry candle of the trade, becomes your entry, and the high or the low point, depending on whether you are short selling or buy, becomes your stop loss. Exit is subjective, but I found that this strategy easily yields, whenever it works, about 20 to 30%. So you do get a risk reward of easily about 3:1, 4:1, or 5:1. Such kind of trades are easily, you can execute such trades with this particular strategy. Now I'll come to the stock selection part. Now in stock selection, you don't have to stick only to high beta. In this particular strategy, you can select low beta stocks as well, because it's all about change in sentiment that happens or that plays out in low beta stocks as well. This pattern is again rare. It does not form that often, but the odds are always high. This is actually one of the highest probability reversal patterns that you will find both on the bearish and the bullish side. So whenever this plays out, especially with expansion of volume, do take a note. Stock universe can be anything. It can be stocks comprising in FNO segment, or in case you don't like short selling, you can just stick to equities only. One volume criteria that you can add just to avoid illiquid stocks is that over a period of 252 days, the average volume should be greater than 5 lakhs, right? Or 500,000. Again, no fundamental criteria is required, but in case you want, you can experiment with the good fundamental stocks, but I don't think that increases the effectiveness of this pattern. It might increase on the bullish side, but I haven't tested that, so I'll refrain from commenting on it. One criteria that I always share in all of my strategies, that always check for the stocks in the same sector. So let's say Godrej Consumer in the FMCG sector is forming this bearish pattern, and the chart is indicating that price will move lower. Check out other stocks. They may not be forming this same pattern, but they might be indicating same amount of bearishness in other forms. So do take a note of that as well. Now I'll move to position size. Again, this is a very common slide that I put out in every swing trading strategy. So it's a repetition of that. So you are not willing to risk more than 1% of your capital. So assuming your capital is 1 lakh, your risk would be 10,000. If 280 is your entry, stop is 260. Your position size would be your risk, that is 10,000, divided by your entry minus stop, that is 20. So 500 units. So the formula for position size is risk divided by the difference of entry and stop loss. In this particular outside bar pattern, your second candle is the most important one. So if you're buying, the low point of that candle becomes your stop loss. Whereas if you're short selling, the high point of that candle becomes your stop loss. One thing I want to add is wait for the end of the week to play out. Don't take a trade assuming that this candle is, or this pattern is forming at midweek. Please don't preempt, because sometimes the mistakes are really costly. Just be patient and wait out. As it is, you intend to capture the next 20-30% of the move. So getting in early 1% or 2% early, it would make a difference. So I'll just repeat the key points. Time frame has to be weekly. There has to be a major trending move. Volume addition is a criteria you can definitely explore, although that's not a prerequisite. Now, decisiveness of the second candle usually determines the success of this strategy. That is why focus on the second candle. Learn to think in psychological terms, like I showed you. Be in the position of the trader. Let's say in case you're trying to short the market, you've had a nice trend in place. Imagine you have a position and then you see a sudden shift happening. Just try and think from psychological point of view. Your trading would naturally improve over time. What I've found is that due to the nature of stock market, which usually trends up after a down cycle, and in general also the bias of stock market is to trend higher, this pattern actually does work better on the buy side. So I usually don't pick out this pattern for short sell that often. I usually stick to the buy side only, but it depends on the underlying market conditions. Like the conditions that we have now, I would definitely look for reversal trades as well. Again, don't forget to check the stocks from the same sector. That is the sister stock concept that I've discussed many times. So I was due to release options video this week, but because of the kind of market that we are into, I thought that I would cover a reversal pattern. Again, I covered a reversal pattern 2 weeks back. That is the kicker pattern of candlesticks. And I thought that again, a reversal pattern at this particular time would be more handy, which is why I made out a swing trading video this week and not an options trading one. So you can contact me on my mail address, Twitter, or on YouTube as well, and I'll get back to you with whatever query you have. So thanks a lot for watching this video. In case you have any doubt, just leave a comment below and I'll answer it as soon as possible. Be safe, guys.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.